So in this session we are going to see the fifth and residuary head of income is income from other sources. Every income which does not specifically fall under any of the other heads, namely salaries, income from other sources, business or profession, and capital gain, and certain specified incomes which will be included in this head. So income from other sources is covered under section 56 and it has got two types of income. One is general income and another one is specific income. General income are those income which cannot be included in any other head. It is covered under section 56 subsection 1 includes those incomes which cannot be chargeable to tax under any other head. The examples of general income are interest on bank deposit, interest on investment, salary received by members of parliament and members of legislative assembly, salary to directors, directors sitting fee for attending board meeting, income from subletting of house property by a tenant, family pension received by the members of deceased employee, examination fee received by the teachers from an institution other than employer, insurance commission, income from undisclosed sources, free fees from a vacant piece of land, agricultural income other than those which are situated in India, interest on loan, directors commission for underwriting shares of new company. Specific income which are specifically taxable under this head, few among them are dividend received, casual income like winning from lotteries, crossword puzzles, races including horse race, card games, other games of any sorts of gambling. The point which you have to remember in this is the income which is generated out of race asses, that is the stake money which is received from race asses is also taxable under this head, but the expenses on maintenance of race asses can be deducted only out of the stake money. It cannot be deducted out of winning from race ass or any gambling. So in case of casual income, no expenses is allowed as deduction. Next, interest on securities and composite rent. If it is house is not separatable, machinery is not separatable from house, then composite rent and letting out of machinery, plant and furniture is taxable under this head under the category of specific income, which is covered under section 56 subsection 2. So deductions which can be claimed under section 57. First one is a family pension for which the reduction allowed is one third of such family pension or rupees 15,000, whichever is less. So for family pension, a standard deduction is allowed, that is one third of such family pension or rupees 15,000, whichever is less. Interest on compensation or enhanced compensation is 50% of such income is allowed as deduction. Brokerage commission paid to agent, for all these they can claim 100% deduction, but brokerage commission paid for purpose of collection of dividend is not allowed as deduction. Interest on loan taken for the purpose of investment in securities and shares, it can be claimed 100%. Any expenditure related to composite rent, expenditure on repairs, insurance premium paid for the asset depreciation, etc., is allowed as deduction. In case of subletting income, repairs and insurance regarding to subletting portions can be claimed as deduction. Any expenditure which is made to generate that income which is taxable under this head can be allowed as deduction under section 57. So under section 58 they have given you the amounts which are not deductible, that is any personal expenses of assessee is not allowed as deduction. Interest paid outside India without deduction of TDS is not allowed as deduction. Payment of wealth tax, then any cash payment exceeding rupees 10,000 and 35,000 in case of transport companies is not allowed as deduction. It should be paid through a digital mode or through a check, cross check, or through a demand draft. Otherwise, it cannot be claimed as deduction. Expenses regarding lottery, crossword puzzles, race, card games, gambling, betting are not allowed as deduction. Any expenses incurred in relation to an exempted income is not allowed as deduction. So for casual income, the TDS applicable is 30%. So it's generally the casual income is received by the assessee only after deduction of tax. Hence, while calculating income from other sources, when net amount of winnings is given, we have to gross it up to find the full value of the winnings. So we have to use this formula, net amount received. If net amount is given, we will be taking the net amount received into 100 divided by 70. So 30% is TDS, 100 minus 30, we will be getting 70. So 100 divided by 70, we will get the gross income. If lottery income is less than rupees 5,000, then there is no TDS for it. In case of horse race, it is 2,500. Family pension, as we have already discussed, the deduction allowed for family pension is rupees 15,000 or 1/3 of family pension, whichever is less is allowed as standard deduction. Next is gift. Gift, we have three types of gift. One is cash, another one is movable property, another is immovable property. If cash is received without any consideration, if the aggregate value of the cash which is received in the previous year, if it exceeds 50,000, then it is taxable. In case of movable property, there are two types of assessment. One is without consideration and another one is inadequate consideration. So only a partial amount will be paid for it, so that is what we call it as an inadequate consideration. If it is without consideration, we then have to take the fair market value. If the fair market value exceeds rupees 50,000 in the financial year, then the entire amount is taxable. If it is of inadequate consideration, we have to take the fair market value. From the fair market value, we have to deduct the actual consideration which is paid by the assessee. After deducting that, the amount exceeds 50,000. Then the excess amount is fully taxable. In case of immovable property also, we have to see whether it is without consideration or inadequate consideration. If it is without consideration, then we have to take the stamp duty value of the property. If the stamp duty value of the property exceeds 15,000, then such stamp duty value is fully taxable. In this case, we have to take it for each property, not for the financial year. Whereas in case of cash and movable property, we will be taking an aggregate value for the financial year. Whereas in case of immovable property, you have to calculate this for each and every property. If it is with inadequate consideration, then you have to tax the excess. You have to see the excess amount, you have to compare it with the stamp duty value and actual consideration paid. If the excess amount is more than 50,000, then that such inadequate portion is taxable in the hands of buyer. So this section is not applicable if it is received from any relatives. So who are relatives? Spouse or spouse of the individual, brothers or sisters of the individual, brother or sister of spouse of the individual, brother or sister of either of parents of the individual, any lineal ascendant or descendant of the individual, lineal ascendant or descendant of the spouse. So only these people are called as relatives. Any gift which is received on the occasion of the marriage of individual is not taxable. Anything which is transferred through will or by the way of inheritance is not taxable. Anything which is received in contemplation of death of the party is not taxable. Any gift which is received from the local authority or any trust or institution which is registered under section 12AA is not taxable. Yeah, there's a question. Mr. Aniket received the following gift during the previous year 21-22. He received a gift in cash of rupees 20,000 from his uncle. So here uncle is not under the definition of relatives. As we have already seen who are relatives, uncle doesn't comes under the category of relatives. So if uncle is a brother or sister of an individual, brother or sister of either of parents of the individual, it should be mentioned there. Here just a name uncle is mentioned, so we are not going to consider uncle as per the definition of Income Tax Act. So 20,000 is liable for taxation. Next, he received a check of rupees 30,000 as a gift from his brother. The gift is from his brother, so it is not taxable. Received a gift of rupees 21,000 on his wedding. The gift is received on wedding, so it is not taxable. He received 25,000 as gift from his non-resident friend. Yes, received a gift from a non-resident friend. So this 25,000 is taxable. He received a gift of rupees 51,000 from his brother-in-law. So brother-in-law is a brother of spouse. So this is not taxable. He received 5,000 from Mr. Z, his resident friend. So 5,000 is taxable. All these gifts are received in the previous financial year. So the aggregate of these one which is taxable, that is number 1, 20,000 received from uncle, 25,000 received from resident friend, and 5,000 received from spread. When you add up these, if the aggregate value in the financial year, if it exceeds rupees 50,000, then it is fully taxable. If it does not exceed 50,000, then it is not taxable. So monetary gift which is received from uncle 20,000, cash received from non-resident from 25,000, cash received from resident from 5,000 is taxable. So 20,000, 25,000 and 5,000. Totally it is 50,000. It does not exceed 50,000. So it is not taxable. If it exceeds 50,000, then it is taxable. Here we have another question. Mr. G. Bedi owns houses at Bombay and Bangalore. These houses runs for races at the race course. During the year 21-22, Mr. Bedi submits the following information. So expenses on race horses at Bombay is rupees 2,60,000. Expenses of race horses at Bangalore is 4,30,000. And the stake money earned by these horses at Bombay is 1,20,000 and at Bangalore is rupees 5 lakhs. So the expenses on race horses can only be adjusted from the stake money or prize money in the race horses. If it is not possible, you can carry forward such losses for 4 succeeding years and it should be adjusted only from stake money or prize money. Here in this case, the total of the stake money comes to 6,20,000, whereas the expenses on race horses is 6,90,000. So when you adjust it, still the 70,000 will be a balance. That balance loss has to be carried forward for 4 succeeding years and it should be adjusted only from stake money or prize money. And during the year, Mr. Bedi received 1,05,000 on betting during horse races. So this is gambling. For you cannot adjust the expenses of race horses from this gambling. So this is casual income. So he has received 1,05,000, which is after TDS. The net amount, which is after TDS. So you have to gross up this value. To gross it up, net amount, that is 1,05,000 into 100 divided by 100 minus rate of TDS. The TDS is 30%, so 100 divided by 70. So it will be 1,50,000. So the amount received as stake money from race horses is 6,20,000. From that, we will be deducting the expenses on maintenance of race horses, that is 6,90,000. So the balance, which is 70,000, it has to be carried forward for the next 4 years and it should be adjusted only from stake money. Race winnings 1,50,000. So income from other sources is 1,50,000. Next question. Compute income from other sources from particulars given below. Interest on deposit with a company, rupees 10,000. It is fully taxable. University remuneration for working as examiner, rupees 6,000. Income which is earned from person other than employer, it is taxable under income from other sources. So university remuneration for working as examiner rupees 6,000 is fully taxable. Royalty for writing books 60,000, and he claims to have spent 20,000 on writing these books. So royalty income is taxable under this head under the general income category. So any income which is taxable under this head, for that you can claim expenses which is made to earn such income. So here for writing books he has spent rupees 20,000. So you can claim it as deduction. So balance 40,000 will be taxable. Dividend declared by our company is rupees 6,000. So previously dividend from Indian company was exempted from tax. For this assessment here it is taxable. So 6,000 is taxable. Interim dividend is also taxable, 3,000 fully taxable. Stake money on raise asses, 1,50,000. So here they have given this from this income you can deduct the expenses related to maintenance of race arses. So arses are maintained by him and the expenses on maintenance of these arses are 2,40,000. So stake money from race houses is only 1,50,000. From that, when you adjust this expenses on maintenance of race houses 2,40,000, the balance will be 90,000, which has to be carried forward for 4 succeeding years, and it should be adjusted only from stake money. Family pension received is 36,000. From this family pension, you can claim deduction under section 57. Actual or 1/3 of rupees 15,000 or 1/3, 33, 1/3 percentage, 1/3 of the family pension, whichever is less. So here 1/3 is 12,000. So 12,000 is the least value, so you can claim it as deduction under section 57. So 36,000 minus 12,000, 24,000 is taxable. The next topic is interest on securities. So in interest on securities, we have two types of securities. One is less tax security and another one is tax-free security. So in less tax securities, we have government security and commercial security. In case of tax-free securities, or also we have government securities and commercial securities, whereas government securities in which is tax free, it is exempted from tax for which there is no tax. So in case of securities, the tax will be deducted at source. Before giving interest, the tax will be deducted at source. So before making payment of interest on securities, it is the duty of the security issuing authority to deduct tax at source on such interest payable at the rate which is in force during that particular previous year. So if it is a government securities, there is no TDS for government securities. So we need not gross it up. There is no TDS for government securities. If it is a commercial securities, if interest rate is given in your question, no need to gross up. Whereas if interest amount received is given in your question, You have to gross it up. Either it may be listed or unlisted, you have to gross it up. In case of tax-free securities, we will be dealing only with commercial securities. You have to gross it up both, whether interest rate is given or the amount of interest is given. In both the cases, you have to gross it up. So when we should gross up, if it should be a commercial security. If it is a less tax securities, you will not be grossing up when the percentage is given. Whereas if amount of interest received is given, you have to gross it up. Whereas in case of tax-free securities, we have to gross it up both the cases where either it is an interest rate or it may be an interest amount which is being received. In both the cases, we have to gross it up. So how to find whether it is a government security or a less tax commercial security or tax-free securities. If it is a government security, they will mention it as a government in your question itself. If it is a if it is a tax-free securities, they will mention you it as tax-free securities. If nothing is mentioned, it comes under the category of commercial securities. So you have to see what is mentioned in your question. If it is a government security, they will mention it as government securities. So in case of government securities, there is no TDS, so we will not be grossing up anything. We will be taking the interest amount as such and we will be taxing it. If it is a tax-free securities, they will mention it as tax-free securities. In that cases, you have to see whether the interest rate or amount is given. You have to gross up in both the cases. Either it may be interest rate or a interest amount. In both the cases, you have to gross it up. If nothing is mentioned in your question, it belongs to the category of commercial securities. So when it is a commercial securities, no need to gross it up when interest rate is given. You will be taking it as such and you will be taxing it. Whereas if interest amount is given, you have to gross up that net interest received. Mr. A invested rupees 1 lakh in 9% tax-free debentures of a company. So here it is clearly mentioned it is tax-free securities. So in case of tax-free securities, I told you that you have to gross it up in both the cases, whether it is of interest rate or it is the interest amount received. Here they have given you interest rate, still you have to gross it up. So what will be the taxable interest for the previous year if the rate of TDS is the rate of 10%? So they have given you interest rate, still we have to gross it up. To gross up this, first you have to find the interest amount. So 1 lakh into 9%, it comes to 9,000. So after getting the value 9,000, you have to gross up this 9,000. So 9,000 into 100 divided by 100 minus 10. 10 is the rate of TDS which is deducted. So the actual interest which was due to him was actually 10,000. Out of this 10,000, the issuing authority has deducted 10% TDS. After deducting 10% TDS, after deducting 1000 rupees TDS, they have given the interest amount as 9,000. So this is the net amount which is being received by the debenture holder, and 10% TDS has been deducted. To find the total value, we are grossing it up. So the gross value of this debenture interest is 10,000. For this only we have to calculate tax and not for this 9,000. Another question, Mr. R held the following investments First one is 90,000, 10 percentage tax free debentures. Again, this is a tax free debentures. They are given you interest rate. So you have to gross it up when interest rate is given for tax free securities. Second one is a Punjab government securities. So this is government security, and for government security there is no TDS. So we can take it as such. 1 lakh into 12 percentage, you will be getting 1,200. Sorry, 1 lakh into 12 percentage, you will be getting 12,000. So 12,000 is taxable. So 90,000 into 10 percentage, since it is a tax free, you will be getting 9,000. 9,000 into 100 divided by 10, it will be 10,000. So 10,000 is taxable. Second is a government security. For government securities, there is no TDS, so no need to gross it up. We can take it as such. 1 lakh into 12 percentage, you will be getting 12,000. So total. So here there is a question. Compute income from other sources of Mr. Krishnamurthy, who held the following investments during the previous year 21-22. Rupees 11,000, 10 percentage central government security. So this first one is a government security. So there is no TDS. For this government securities, there is no TDS. So we will be taking this 11,000 as such. 11,000 into 10 percentage, you will be taking it as 1,100. Next, 36,000, 10 percentage tax free commercial securities. So this is a tax free commercial securities. We have to gross it up. So we have to find what is 10 percentage of 36,000. You will be getting 3,600 into 100 divided by 90. Next, 6,300 received as interest on tax free public limited company securities. So this also we have to gross it up. 6,300 into 100 divided by 90, because this is tax free commercial securities. They have given you the interest amount. So in case of tax free commercial securities, we have to gross it up. In both the cases, either they give you interest rate or interest amount. Next, fourth one, 7,200 received as interest on government securities. So for government securities, we need not gross it up. There is no TDS. We can take it as such. That is 7,200. Next, 4,000 received as interest on debentures of Deepak Fertilizers listed. So for listed, if the interest rate is less than 5,000, if it is less than 5,000, there is no TDS for them. So you can take it as such, 4,000. For debentures, if the interest on debentures does not exceed rupees 5,000, then we need not, they will not collect TDS for it. So you can take it as such, rupees 4,000. It's 30,000, 13.5% securities of paper mill company limited listed. So this 30,000, 13.5% belongs to less tax securities. So in case of less tax securities, if the interest rate is given, we need not gross up. So can take it as such, 30,000 into 13.5%. Next, 35,000, 11% securities of paper mill company limited. Again, this is also less tax. So 35,000 into 11%. 10%, 15%, Jaipur Municipal Corporation bond. So this belongs to government security. So no need to gross it up. 10,000 into 15,000, 15 percentage. We'll be getting 1,500. It will be taxed. Dividend from Corona Limited, 4,000 fully taxable. During the year, he got a prize in Karnataka State Lottery. The net amount which is received by him was rupees 35,000. So net amount we have to gross it up. So 35,000 into 100 divided by 70. Interest on all securities is payable on 1st of every year. Bank charges rupees 200 as collection charges. So after calculating the total income for this, from that you can claim deduction under section 57 for the bank charges 200. So computation of income from other sources. So first one, 11,000 at the rate of 10 percentage. Central government security. Thousand hundred. Second one, 36,000 10 percentage tax free commercial securities. Tax free commercial securities. So they are given you interest rate. So 36,000 into 10 percentage. For the value which you have to gross it up into 100 divided by 90. So we'll be getting 4,000. Third, again it is a tax freeze. 6,300 into 100 divided by 90. We'll be getting 7,000. Next, fourth one, it's a government security. $7,200. Next, 4,000 received as interest on debentures of Deepak Fertilizer. So since the interest is less than 5,000, there is no TDS, so you can take the value as such 4,000. Next, sixth one is a less tax securities. They have given you interest rate, so no need to gross it up. Paper mill company, 30,000 into 13.5 percentage. $4,050. It's 35,000, 11 percentage paper mill. This is also less tax. So 35,000 into 11 by 100. You're getting 3,850. Eighth one, Jaipur Municipal Corporation bond. So 10,000 into 15 percentage. 1,500. Next, ninth one, dividend from fully taxable 4,000. Karnataka State Lottery. We have to gross it up. So 35,000. They have given you the net amount, so you have to gross it up. 35,000 into 100 divided by 70. 50,000. The total comes to 86,700. Less its deduction under section 57, bank charges. Income from other sources. $86,200. So here we have a question. Mukund furnishes the following particulars of income for the previous year 21-22. From this we have to calculate the total income which is taxable. So dividend from an Indian company. So this is an specific income and 600 is fully taxable. Again, dividend on preference shares of an Indian company. This is a specific income and 3,200 is taxable. Income from letting of building and machinery, the composite lease is 17,000. This 17,000 is taxable. From this 17,000, you can deduct any expenses incurred for this. You can deduct any expenses incurred for earning this income. So the expenses are given here. One is allowable depreciation on building and machinery is rupees 4,000. So you can deduct that 4,000. And another one is fire insurance on building and machinery 100, 4,100. So we can deduct 4,100 from this 17,000. Expenses 4,100 from this 17,000. Balance will be taxable. So when you deduct 4,100 from this 17,000, you'll be getting 12,900. 12,900 is taxable. Interest on bank deposit 2,500 is taxable. This is general income. This is general income. And the previous one, that is the income on letting of building and machinery, it is specific income. Directors sitting fees, general income, fully taxable. 1,200 is taxable. Ground rent 600 is taxable. It is general income. Income from undisclosed sources. For this, they are supposed to pay tax at the rate of 60%, at a flat rate of 60%, and this is taxable under this head. So it will come as general income. 10,000 is taxable, and the rate of tax will be at the rate of 60%, flat rate. Income from lotteries, they have given you the gross value. The gross value is 10,000, so we can take this as such. No need to gross it up. So this is specific income. So the following deductions are claimed by him. This deduction on dividend rupees 20 is not allowed. While calculating dividend income under the head income from other sources, the shareholders can claim deduction of only interest expenditure which can be incurred to earn the dividend income to the extent of 20% of total dividend income. No deduction will be allowed for any other expenses like commission, remuneration paid to a banker or any other person for the purpose of realizing such dividend. So the collection charges in respect of dividend income on shares or units of mutual fund shall not be allowed as deduction. So the collection charges is not allowed as deduction. The other two deductions you can deduct it from the income which is generated out of building and machinery, composite lease. So general income, we have interest on bank deposit, director fees, ground rent, income from undisclosed sources. So specific income, we have dividend on equity, dividend on preference shares, winning from lottery, rent of building and machinery. From that we will be deducting depreciation and fire insurance. So the taxable is 12,900. So total income from other sources is 41,000. Thank you.